For 2 years, the yield is 5%. And then after 2 years, you will get back the 10 lakhs. So 5%, 2 years, present value interest factor annuity is 1.859. And the present value interest factor is 0.907. The answer is 10,55,720, which is higher than the maturity value. The price is higher because the yield is low. Yield is only 5%. Okay. Now, third step, we need to calculate what is his total return by having this particular horizon period, horizon strategy. So he's keeping this bond for 4 years. So after 4 years, he's reinvesting. So 80,000, and he's reinvesting at 5%. So 80,000, 1.05 power 3. So he's investing after first year interest he will receive at the end of the first year. So he will reinvest for 3 years. So 80,000 into 1.05 power 3. That is, we are calculating the future value. We are calculating the future value of the interest payment. So you are investing for next 3 years. You will be receiving at the end of the first year. So you will be reinvesting after a third year. So 3 years you are going to reinvest. So 1.05 power 3. Then second year, 80,000 into 1.05 power 2. 2 years you are reinvesting. Third year, you are reinvesting for 1 year. Fourth year, you cannot reinvest because you will get back your interest. So your total value of reinvested interest is 3,44,810. Now, this is your interest income. Now look at the capital appreciation, your capital gain yield. The price is the forecasted price after 4 years, it is 10,55,720. The original price was 10,47,280. That is your capital gain. Okay. So divide by the original price. That is 0.3373. That is your 4-year return. Okay. The last step is compute the annualized return. So how do we get annualized return? 1 plus R power 1 by N minus 1. 1 plus R power 1 by N minus 1. So 1 plus R, that is 0.3373. That is power 1 by N. That is for 4-year horizon period, 1 by 4 minus 1. You will get 7.54. So 4 steps. First, we need to compute current price. Second, you need to forecast the bonds. Depends on your investment period, depends on your horizon period. Then compute your total return by calculating the future value of coupon rate and the changes in the bond value, that we call it capital gain or capital loss. Then annualize the return. 7% 6 years. How are we getting it? 4.766. Yeah. So that is the table value. So either you can take the table value or you can do it by yourself. How we do it? Usually what we do is 80,000 divided by 1.07 power 1 plus 80,000 divided by 1.07 power 2 plus 80,000 1.07 power 3, like that. That is the present value of coupon payment. Or just multiply with the present value interest factor annuity. Table value. If the table value is not given, you need to calculate like this. Tejashwani, you got it? You need to calculate. Yeah. Okay. So any clarification, anybody, regarding the steps? Any clarification, anyone? Any clarification? Any doubts, anyone? Now look at the following case. Yeah, same thing. Following case. First, you compute the current price. Current price, 10-year maturity period. 12% is a coupon rate. So 12% on 1,12,000. Currently sells a yield at 10%. So the price will be higher. Coupon rate is 12%, yield is 10%, yield is less, the price will be higher than 1 lakh. So 12,000, 10%, 10 years, the table value is 6.145, and then 10%, 10 years, present value factor is 0.386. You will get 1,12,340. That's the current price. First step. Then what is the horizon period? Look at the case. A portfolio manager wants to forecast a total return on the bond over the coming 5 years. So his horizon is 5 years. So total 10 years. So he wants to keep it for 5 years. After 5 years, he wants to invest in some other bonds. So his horizon is 5 years. Earlier case, his horizon was 4 years. So 2 years he wants to invest because 6 years was the maturity period. Here the maturity period is 10 years. So he wants to keep the bond for 5 years. After 5 years, he wants to invest in some other bonds, which is having lower yield. So he wants to invest in 5-year maturity bonds will sell at 9%. So less than 10%. So the price will be still higher. Okay. So at 12,000 interest that he will get 9% 5 years. Then he will get back this 1 lakh after 5 years. So 9% 5 years present value interest factor is 3.890. Present value interest factor is 0.650. You will get 1,11,680. Now, what is a 5-year? You are receiving the original interest from the first bond. So he can reinvest. He can reinvest. What percentage he can reinvest? He is reinvesting at 8%. 8% he is reinvesting. Okay. So earlier he was reinvesting in, so 8% he is reinvesting. So first year interest you will receive at the end of the first year. So you are reinvesting for 4 years. 12,000, 1.08 power 4. Okay. Then 12,000, 1.08 power 3. 12,000, 1.08 power 2. 12,000, 1.08 to power 1. The last year you cannot reinvest 5th year. So you will get 70,399. That is your interest payment. How much your bond value increased? So here you receive capital loss. The forecast price is 1,11,680. Your original price is 1,12,340. So you incur, the bond investor incurs loss, capital loss. Okay. So capital loss. So divide by your original price, that you will get 0.6208. So how do we get annualized return? 1 plus R power 1 by N minus 1. Somebody is asking, how do we get that? Then he has asked 4-year return. 4-year return, that is 1.6208 power 1 by 5. Here N is 5-year horizon period. 1 by 5 minus 1. That is 10.14. That is your annualized return. Dane got it? 4-year return. So any clarification? Anybody? Any clarification? Anyone? Anyone wants to ask anything? Any clarification? Almost all are attending the session. So now you can go back to the theory part. Now we can go back to the theory part. The steps, what we have, horizon analysis. Yeah, now look at the steps. First step, select a particular investment period or horizon period. First, we need to select and compute the current price of the bond. The first step. The first case, the horizon period was 4 years. Second case, the horizon period was 5 years, and get the current market price. Then second, compute the forecasted price of the invested period. So we need to find out the forecasted price. Okay. Then find out the total return. Add the future value of coupon with the predicted capital gain or loss to get a total return. So we are getting the total return. Then get the annualized return. So annualized return, how do we get? 1 plus r power 1 by n minus 1. Okay, so it's a very important case study for section B. It's very important section B, case study horizon analysis. Bond portfolio management strategies, horizon analysis is a very important case study. So third bond portfolio management active strategy is exploiting mispricing among securities. You can exploit the securities. The bond portfolio managers regularly monitor the bond market to identify the temporary relative mispricing. So they can try to exploit the opportunities by engaging the bond swap, by purchase and sale bond to improve the return. So usually what they do is they buy they buy lower yield bonds so that the price will increase, and they sell higher yield bond. The swap is made from lower yield bond to the higher yield bond. The yield of the later declines to that of the former. The bond holder enjoys a capital appreciation. So it depends on the lower yield bond and higher yield bond. So lower yield bond, the price will increase. Higher yield bond, the price will decline. So buy the lower yield bond and sell the higher yield bond. So when you buy the lower yield bond, the price will increase the later stage. You can sell it at later. And whenever you have a higher yield bond, you sell that bond so that you don't incur any capital loss. That is the swapping. So exploiting that mispricing strategies. Because lower yield bond, if the price quoted is very high, in later stage, the price will decline later. Lower yield, but the price will increase. So in that case, you will get that opportunity. That is the how to exploit the mispricing opportunities. So there may be the price differences. Through those price differences, the bondholder can take the advantage out of it. Yes, horizon case studies are important for section B. It's very important for section B. So you'll have to go through thoroughly all the 4 steps. The hybrid strategy, the combination of both active and passive is hybrid strategy. It is the balancing of both price risk and reinvestment risk. So as all of us know, price risk, there is an inverse relationship between bond and yield. The reinvestment risk is the rate at which the interest income can be reinvested in the future. So both move in the opposite direction. So you cannot take by holding one bond by looking at the price risk and reinvestment risk. So the interest rate, the yield goes up. The yield goes up, what will happen? The price will fall. And then the reinvestment rate improves. So you will get higher rate of return. You can reinvest at a higher rate. So the bondholder receives higher interest. But if the interest rate falls, the yield decreases, the price increases. But the reinvestment rate falls because you reinvest at a lower rate. So the bondholder has to take the balance between the two. The bondholder has to trade off between the two to increase a return with the minimum risk. Okay, that we call it immunization strategy. Immunization is very important. Section A question: what is immunization? Immunization means striking the balance between price risk and reinvestment risk. So you cannot hold the return. You could not hold the bond return with having the price risk and reinvestment risk. So you need to strike the balance between the two. Okay, that is called. So this one, yeah. So we will. So this immunization has got a case.